Canadian Natural Resources just signed a $6.5 billion deal to buy Chevron's Alberta's assets. So what will be the impact of this type of news on the value of this company? This is what you'll find in today's video, where I'll make a full stock analysis on the company Canadian Natural Resources with the ticker CNR. As always, after getting over its business model and its more recent financial results and acquisitions, we'll make a quick fundamental analysis followed by price prediction with different valuation models to determine if the stock is under or overvalued right now. The Canadian Natural Resources Company is an oil and natural gas company that is mainly operating in the west of Canada and that is currently ranking amongst the 20 largest gas companies in the entire world. So before to see what will be the impact of this more recent news on the valuation of this company, let's examine together how they've been able to generate over $36 billion of revenue in 2023. With a diversified portfolio of assets, including a mix of natural gas, light and heavy crude oil, as well as bitumen, Canadian Natural Resources is present in multiple places around the world, including North America, the UK, certain places of the North Sea, and offshore Africa. And so this makes it one of Canada's largest natural gas and crude oil producers. At the beginning of the year, amid rising US demand, Canadian Natural Resources hit a record oil production with over 1.42 million barrels of oil equivalent per day in the fourth quarter, which is nearly up 10% year over year. During that same period, it has also achieved some record quarterly natural gas production with 2.23 million cubic feet per day, capping off the record oil and gas volumes for the full year. Add to this, in their more recent earnings report, we've seen that they've been able to achieve some great results where their net earnings have been increasing year over year by over 17%. And on its side, we've seen that their cash flow from operations have been increasing during that same period by over 48%. With this great performance that was mainly justified by some great increase in all of their different energy segments over the past quarter, we've seen that the company has been able to beat the analyst predictions for both the total quarterly revenue and the total earnings per share in their latest earnings report. And so this has also helped the company to increase their quarterly dividend that is now sitting over 4% with a pretty great payout ratio of only 56%. And so with a dividend growth streak of 24 consecutive years, we could see that this dividend could continue to be increased in the near future. Another interesting fact about this business is that they have an extremely long reserve life index of more than 33 years. This means that at their current pace, they could be able to maintain the reserves without having the needs to acquire new assets for over 3 decades. This means that the investment that you would be making in this company today could easily be there 30 years from now. Also, another positive news for the value of this company is the current ongoing conflict that is going on right now in the Middle East between Iran and Israel. As tragic as it is in terms of human lives, it is important to note that Iran is currently amongst the 10 largest oil producer countries in the entire world. This means that any disruption to Iran's energy industry could significantly impact the global supply, which could lead to higher oil prices. However, with this unstable environment, this underscores the potential value of such an important North American assets as the Canadian Natural Resources have, plus the recent $8.8 billion acquisitions of Chevron's assets of about 20% interest in the Athabasca oil sands project and 70% stake in the Duvernay shale. This will massively help this Canadian company to increase their natural gas and their crude oil production for the future. However, the biggest criticism that I have for this type of company is that they currently have no investment at all into different green renewable energy sources. With an economy that is going more and more towards renewable energy sources, it means that this type of company will imperatively needs to adapt sooner or later towards this type of energy. They could copy the business model of one of their big competitors, Enbridge, which is basically investing a big portion of their capex towards green renewable energy sources, but they are still earning the largest part of their income from the different transportation and production of natural gas and crude oil. So now let's see what the different valuation metrics are telling us about the true intrinsic value of CNQ. First, we can see that this company is currently worth close to $106 billion with a pretty cheap price to earnings ratio of less than 15 right now. And so when we compare it to the price to earnings ratio, for example, of one of its big competitors, Enbridge, that is over 20, we could understand that with this indicator, this company would currently be undervalued. Then in terms of the profitability of the company, we can see that they've been able to achieve some incredible profit and operating margin of over 20% for each. And for the investors, an excellent return on equity over the last 12 months of close to 20% as well. During the same period, CNQ has been able to generate some revenue of over $36 billion, and in the last quarter only, it has been able to grow its total quarterly revenue by over 14%. And at the same time, during that same period, they've grown their quarterly earnings by over 17%. However, as most dividend companies, we can see that CNQ currently has quite a lot less cash compared to its current debt. Nevertheless, in comparison to its total equity, its debt percentage only represents close to 30%. Now, in terms of the volatility of the company represents by the beta on a 5-year period, we can see that with the beta close to 2, it would mean that this company will tend to fluctuate about 2 times more than the overall market over the last 5 years. However, over the last 52 weeks, we can see that on its side, CNQ has gained only 12% of value compared to about 30% for the overall market. Add to this, as I mentioned earlier, this company is distributing over 4% of dividend with a pretty great payout ratio of only about 56%. In terms of the total revenue progression over the past 4 years, we can see that if we compare with 2020, this company has been able to quadruple its total revenue, but we can still see that they are far from their total revenue that they've been able to generate in 2022, which obviously is reflected pretty well in their total net income progression over the last 4 years. The situation is pretty much the same in terms of their total cash flow, where we can see that in terms of their cash flow from operating activities, they have been well growing compared to 2020, but they are still far from its all-time high in 2022. And by keeping a capex that is pretty much the same over the last 4 years, we can see a certain fluctuation in their total free cash flow. Finally, to determine what is the true intrinsic value of this company, we'll be using, as always, different valuation models, starting out with the Peter Lynch valuation one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And so with these hypotheses, we can find that with a low future EPS growth that is predicted for the next 5 years, the results would be showing that this stock would currently be quite overvalued. In terms of the second model, which is the dividend discounted model, unfortunately, we won't be able to use it since we can see that our average growth rate is way bigger compared to our weighted average cost of capital. In terms of the third model that we'll be using, which is the discounted cash flow model, where we will simply discounted all the future free cash flow that are projected for this company to find its true value. We need to first start by finding what is the cost of debt, the cost of equity, and the cost of debt and equity, which will give us our weighted average cost of capital. Then with that, we can find what is the future value of our free cash flow, which at the end of the day will give us an intrinsic value of about $35 per share, which is quite less expensive compared to the current price of about $49.39. And finally, for the two last models, which are the Graham's original value formula and the Graham's revised value formula, we can find that with the original value formula model, the stock would currently be undervalued, and with the revised one, we can find that the stock on its side would be overvalued. As you've been able to see in this video, the Canadian Natural Resources is an interesting company for people looking to invest directly in one of the largest natural gas and crude oil producers in the country. All of this while receiving some great quality dividend income from this dividend aristocrat. Obviously, this type of investment has great pros for certain people. For example, having more stability in your portfolio, having a certain edge against inflation, as well as receiving great dividend income from it. However, even if the company has been reporting great financial results in their latest earnings report and that they are able to continuously grow their total operations, well, the different valuation models are showing us that this company would currently be quite overvalued right now. Personally, I haven't invested yet in this company and I don't plan to do it as long as they have not diversified their business model to include, for example, great renewable energy sources. In fact, even if we'll still need different fossil energies for the next couple of decades, I personally believe that by deciding to not invest in renewable energy sources, they are basically cutting themselves from their different competitors in terms of the potential great opportunities that these types of sources could represent for the future. Nevertheless, if you are looking to find other great companies that are quite undervalued right now and that have long-term potential capital appreciation, well, you can check out the video that's going to be right over here and I will see you soon. Peace!